In simpler words, mutual funds are a way to invest your money into a pool of funds that's run by expert, financially savvy people, so called. An investor will then meet with an investment advisor and decide what is the best portfolio for them to buy into. In return, the mutual fund company pays these experts for their time, along with any bonuses and incentives that may come from exceeding performance goals set by investors. Mutual funds have many advantages over investing in stocks alone. They are safer because they don't trade as much, they are more diversified, and they offer more opportunities to grow your money in the long term than stocks would allow. Okay, they also provide a professional management service of your investments so as not to leave it completely up to you. Keep in mind that mutual fund returns can vary and they can be risky as stocks. Okay, if you are looking for a great way to invest, mutual funds are a great option. Okay, how are mutual funds created? Mutual fund companies invest the money from investors into stocks to generate a profit. They do this every day, every week, and every month. The stock market is volatile, which we always know, which means that there are plenty of opportunities for growth of principal investments or for losses to be incurred. When a company invests in stock, it can lose or gain a lot of money depending on what happens in the market. For instance, if their stock portfolio drops significantly in value, they will lose money. In the event that they lose money, they cover their losses with cash reserves provided by investors. This situation is called breaking the buck. In September 2008, a fund called the Reserve Primary Fund broke the buck because it had too many short-term assets, okay, to meet the requirements of investors. It invested primarily in mortgage-backed securities that were not guaranteed by another party, which meant if this company went bankrupt, investors would not get their money back. In the case of Reserve Primary Fund, they could only cover $1 per share with assets. If there was a run on this company at that time due to people possibly losing faith in it, thousands of people could have lost money. Luckily for investors, that didn't happen, and this company survived, as well as its parent company, the Reserve Investment Company, owned by billionaire investor Warren Buffett. A lot of companies that invest in stocks are very careful not to break the buck because they don't want to lose investors' trust. If they do break the buck, they typically buy back shares with the cash reserves that investors have provided them with. In order to keep your money safe, mutual funds must be well managed and monitored. First, there is an investment committee that decides whether or not a stock is a good investment for a pool of investors. Next comes the portfolio manager, who monitors investments and tells brokers what to do for trades. The brokers execute trades, making sure that everything is done as it should be in accordance with company policy and financial regulations. When do mutual funds pay dividends? Dividends are money paid out to investors by the companies they invest in. In a mutual fund, the profits that come from stocks that the company owns gets divided by up to among all of its shareholders based on how many shares of stock they each own. This is a great way to make money because if you have lot of shares, you get more money back, and if you only have a few shares, you get less. The average annual dividend for stocks is about 3%. You can check this information out on the Morningstar website or so. An investor should always look at the amount of dividends paid by the companies in which they are invested and compare them to other opportunities before making a financial decision about where to invest their money. This way they can make sure that their money is going to companies that are paying a good amount of money in return for the investment, and that the investments are safe. How do mutual funds manage risk? Well, mutual funds invest in stocks and securities, and thus must be very cautious about the shares value. Mutual funds can lose even more money than what a stock will lose if there is a run on the bank, because a lot of people may want to sell their shares at the same time. If so many people wanted to sell at once, then the value of the share would drop, causing a loss for holders of it, which is the fund. The company that owns this share would have to buy back shares from investors to cover the loss, selling first and then buying back. Well, this type of situation makes investors losing money because the fund bought back more shares for less than it sold them for. In order to prevent these kind of losses, mutual funds invest in stocks where they know they can sell the gains at any given time. If they lose money, they can still remain there as retain and remain their assets and not to lose their customers' trust. Mutual funds also invest in securities that are protected by other governments or entities such as banks or insurance companies. This way, if a stock crashes because of a bad decision made by a company, there is another entity to salvage the loss. Investing in stocks have also been risky, but mutual funds do all that they can to contain the risk, and other companies take care of them when they don't. The business of mutual funds, from management to trading, is a very complex system that makes sure your money is always safe despite stock market volatility. The people behind the choices made are numerous, from investors to portfolio and investment managers and even regulators who make sure everything goes smoothly. This way, you know your money is in a secure place and ready for the growth. Mutual funds are great for long-term investments because you can have peace of mind knowing that not even a run on the bank will cause you to lose your money. Let us have a walk through to the fun facts about mutual fund industry. The industry is a $14 trillion business which makes up about 3.1% of the US gross domestic product. It is larger than any single company in the US and has been growing since its inception in 1924, nearly a century ago. Okay, more than centuries ago. $6 trillion of the investments held by mutual funds are owned by individual investors as opposed to funds owned by institutions. The average age of investors is 55 years old. Females are more likely to invest than males. The majority of this group have at least some college education. Mutual funds are the most popular way to invest and own stocks. 79.5% of all equities, 78.2% of investors own mutual funds as their primary investment. The US has more mutual funds than any other country in the world, with $14 trillion altogether. These funds have 1.8 trillion in assets, $1.8 trillion in assets, which is 3% less than last year. This marks only the fourth time since 1988 that the industry has seen a decline in assets during a one-year period, and now we can witness the same in 2020 as well as in 22. The average amount invested by individual households placed in mutual funds is $13,000. This figure has remained steady since 1994. The average time that individual households keep money invested in mutual funds is about 5 years. Mutual funds are primarily invested in bonds, which is 41%, stocks 33%, cash equivalents, which is 22%, and commodities, which is 5%. Mutual funds have a 2% higher return than stocks do. All other things being equal, a $10,000 investment will be worth $11,121 after 20 years through mutual fund investments, rather than if they have been used to buy individual stocks. This number assumes a 7% annual rate of return, which is the average annual rate return after inflation for the past century. Go with a portfolio manager if you have a plan to invest in mutual fund. A portfolio manager, also known as fund manager, is the person in charge of managing and monitoring a mutual fund. The portfolio manager acts as an intermediary between the shareholders and the investment committee. The investment committee decides what kind of stocks to invest in, and the portfolio manager makes sure that everything keeps running smoothly. This means making sure the stocks they have invested in are doing well, that they are covering any losses, and they are doing it all with the company policy. Some companies don't allow these managers to invest more than a certain amount per month. The portfolio manager also has to make sure that the stockbrokers are doing everything correctly and that there are no mistakes in the recording of profits and losses. Invest smart, safe and wise. Win profits, God bless. If you haven't subscribed to my channel, please do subscribe, like, share and keep supporting us. Thank you. Bye.